The International Federation of Accountants established the IPSAS to solve a specific global problem, developing high-quality accounting standards explicitly designed for the public sector. These public sector standards draw heavily on the private sector's IFRS rules, yet applying corporate accounting logic directly to a sovereign government creates an immediate paradox. The disconnect is in their organizational DNA. Corporations exist to generate a return on equity. Public sector entities exist to deliver services to the public. Because of this, traditional metrics like profit margins or return on investment fail to capture a government's actual performance. A high financial surplus might mean the government is running efficiently, or it might mean it severely underfunded critical welfare programs. To accurately measure how governments report on their accountability and sustainability, we have to rebuild the accounting framework from first principles. That blueprint is the IPSAS Conceptual framework. Standard corporate accounting breaks down in this environment because the ultimate goal of a sovereign state is the effective distribution of services, not the accumulation of cash. The foundation of this new conceptual architecture is what the IPSAS defines as the public sector environment. This node-based model illustrates how the public sector operates under 5 distinct structural pillars that force a deviation from private enterprise mechanics. The first and most critical pillar is the prevalence of non-exchange transactions. In a non-exchange transaction, an entity receives value from another party without directly giving approximately equal value in return. Taxation is the prime example. It is a compulsory transfer. The level of services an individual receives is rarely proportional to the taxes they pay. This compulsory mechanism shatters traditional corporate revenue recognition. You cannot evaluate a government's revenue as a measure of consumer demand when the constituents are legally required to hand over the cash. The second pillar shifts our focus to the approved budget. In the public sector, a budget is not a simple financial forecast. It is the strict legal basis for taxation, the formal authorization for spending, and the primary mechanism for legislative oversight. The third pillar is the extreme longevity of the public sector. While political administrations rotate, nation-states have near-infinite time horizons. They can fund long-term social programs and issue sovereign debt with maturities extending for decades, operating on a timeline mortal corporations cannot replicate. Returning to our architectural model, the final 2 factors shaping this environment are the government's regulatory role and its reliance on specialized assets. Unlike corporations, governments hold specialized assets like road networks purely for their service potential rather than cash generation. Furthermore, the state's regulatory role allows it to create rights and obligations through law, creating unique assets and liabilities that simply do not exist in the private sector. These unique environmental conditions, from compulsory taxation to regulatory power, dictate a bespoke set of axioms. You cannot measure a state's sovereign obligations or its service-based assets using private sector yardsticks. With the environmental foundation set, the framework moves to the next layer of deduction, identifying exactly who consumes this bespoke financial reporting. The IPASS identifies 2 distinct primary user groups who do not have the authority to demand customized financial data from the government. The first group is service recipients. These are the citizens and eligible residents who rely on the public sector to deliver essential, long-term services. The second group is resource providers. This encompasses involuntary taxpayers, alongside voluntary lenders and international donors who fund the entity. While legislatures and parliaments are heavy consumers of these reports, the conceptual framework defines them strictly as representatives acting on behalf of these primary users. Both groups analyze public sector financial data to achieve 2 specific objectives. The decision-making objective involves users utilizing the data to inform voting preferences, evaluate sovereign lending risks, or influence future resource allocation. The accountability objective addresses the government's obligation to prove it managed entrusted resources safely and deployed them effectively. In the public sector, accountability carries a specific mathematical burden, proving that involuntarily raised resources were legally and efficiently converted into intended service outcomes. The mechanism designed to satisfy these users and objectives is the General Purpose Financial Report, or GPFR. This concentric circle visualization illustrates a standard corporate annual report. Traditional financial statements, detailing financial position, performance, and cash flows, live entirely inside this small, innermost ring. But a clean balance sheet and cash flow statement are mathematically insufficient to satisfy a government's accountability objective. This forces the first required expansion of the GPFR scope. IPSAS requires the integration of actual versus budget comparisons. This proves the entity's legal adherence to the democratic spending mandates established at the start of the year. Next, the framework mandates a second expansion. Governments must include non-financial quantitative measures, tracking both outputs and outcomes. This data proves whether the entity actually achieved its public policy goals with the money it spent. Finally, we reach the most complex expansion of the GPFR scope. Intergenerational commitments, like sovereign debt and long-term social benefit programs, require rigorous forecasting. Users need prospective financial information to assess future resource needs and long-term sustainability. The resulting general-purpose financial report bridges the gap. It connects purely financial inputs in the present to tangible, non-financial service outcomes stretching across decades. Expanding the scope of financial reporting introduces a massive volume of data. To keep this information standardized and useful, the framework applies a set of qualitative filters. This filtering mesh governs the data, ensuring it remains focused on relevance, faithful representation, and verifiability. Faithful representation in the public sector means depicting the economic substance of complex phenomena completely, neutrally, and free from material error. But this creates an inherent tension. Prospective financial data about future sustainability is highly relevant to citizens, yet it is incredibly difficult to verify due to uncertain long-term estimates. To prevent governments from manipulating these estimates, the framework introduces the principle of prudence. Exercising prudence forces caution under conditions of uncertainty. It ensures that assets and revenues are never systemically overstated, and liabilities and expenses are never understated. The IPSAS framework constantly calibrates this balance, weighing the immense relevance of predicting a state's future sustainability against the strict requirement for verifiable, faithfully represented data. Looking at the completed architecture, the logical progression is clear. The IPSAS conceptual framework is a bespoke, rigorously deduced model. It is designed specifically to solve one problem: holding immortal, tax-funded entities financially accountable for their actions. General-purpose financial reports under IPSAS serve as the primary link between involuntary taxation and the long-term survival of public services. They transform technical accounting data into a transparent record of how a sovereign entity fulfills its promise to the future.